Picture a roller coaster at a theme park that just installed a new loop. Crowds cheer, a few people scream, and next week some safety inspector might whisper that the bolts need tightening. That's Supermicro computer, SMCI, in a microcosm. Wild intraday moves, a fresh round of analyst drama, pockets of heavy trading and pockets of silence, and investors trying to figure out whether today's headline is a buying opportunity or a flashing warning light. SMCI popped 10.94% on Friday, but the stock was down about 3.8% in pre-market trading the following Tuesday, volatility on replay. Year-to-date SMCI is up 11.5%, but it's essentially flat over 12 months, plus 0.6%. That's weaker than the S&P and many tech ETFs. Trading that day was muted. 1.5 million shares changed hands versus a 3-month daily average of 24.77 million, a giant gap that tells you institutional engines were quieter than retail traders. The price moves and the small print trading story. Friday's 10.94% rally was dramatic. These big up days are often driven by concentrated flows, big options activity, a block of institutional buying, or short covering. But after any big pop, a natural retracement or pre-market wobble can follow. On Tuesday SMCI was down 3.8% in pre-market trading. Those whipsaws are normal in high beta names, but they feel extreme when you're watching your P&L on a phone at breakfast. Now, the volume punchline: only 1.5 million shares traded that day, versus a 3-month daily average of 24.77 million. That's a huge divergence. It tells us the rally and dip were not accompanied by broad, sustained institutional rotation that day. The market was relatively quiet, which makes price moves more fragile. Thin trading days mean prices can be moved by a relatively small pool of orders. Conversely, big volume days, like the 77.8 day seen midweek in other sessions, signal a deeper conviction. So when you see either a huge rally or a tiny volume day, treat both as clues, not final answers. Year-to-date and 12-month performance: mild gains, big story. SMCI's 11.5% year-to-date lift looks good in isolation, but the 0.6% 12-month gain is essentially flat versus a broad market that has been much stronger, e.g., S&P 500 and tech-focused ETFs. That relative underperformance hints at two things: either the market has already punished SMCI for near-term concerns, which could leave upside if things improve, or the company is under structural pressure that makes investors favor other tech names. Which is true depends on whether you believe margins will recover and bookings will hold. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. Analysts, split opinions, hold consensus but sharply different views underneath. Wall Street's headline is "Hold," but the underlying deck is fractured. Multiple trackers show differing counts. Some sites show the mix as roughly 8 hold 2 sell, others use slightly different tallies, and TipRank stated the recent sample as 5 buy, 5 hold, 2 sell. The exact counts change as firms update coverage. The net effect is the same. Analysts are evenly split, labs of both bulls and bears exist, and consensus averages an analyst price target in the low to mid $40s. Stock analysis lists about $44.35. That average target implies meaningful upside from current trading levels. But averages can hide extremes. Some targets are as high as the 80s/90s and some as low as the mid-teens. Why does this matter? Because when analyst opinions diverge, market moves depend heavily on narrative and catalysts. Earnings, supply chain headlines, and big customer wins/losses can swing sentiment quickly. In this case, the consensus hold is a neutral midpoint, not a resounding buy signal. The Goldman Sachs Sting, Catherine Murphy's sell and $26 target. Goldman Sachs' Catherine Murphy entered the room with a bearish initiation, sell and a $26 target. That's material because a sell from Goldman is frequently treated as a red flag by institutional clients and momentum desks. Murphy's logic: Summarized in multiple outlets, centered on ongoing margin pressure, the shrinking profitability picture in Tier 2 cloud markets, and limited visibility into sustainable earnings as competitors bite into pricing. In short, her model says the likely near to medium-term path for SMCI is down, not up. If you're picturing this, imagine a restaurant critic saying the little pizza place's crust is undercooked and that cheaper supermarket pies now taste nearly as good. That critique is enough to cost the restaurant a few regulars, especially those who care less about authenticity and more about the price tag. For SMCI, the price tag is gross margin and predictability. Why margins are the central panic point. When Murphy and others talk margin pressure, they aren't using banker babble, they're pointing at the economics that make or break hardware companies. Supermicro's business mixes high-volume systems, GPU-dense racks, and OEM supply deals. If commodity prices, HBM, DRAM, GPUs, spike or if customers demand price concessions to secure volume, gross margins erode fast. Margin erosion matters because even healthy revenue growth can be accompanied by shrinking profits, and the market hates revenue without margin. Imagine selling $1,000 pizzas with $400 ingredient cost, 60% gross margin. If ingredient costs or discounts push costs to $600 per pizza, that 40% drop in gross margin quickly turns a comfortable profit into thin returns. Hardware businesses behave the same way at scale. The average $44 target, hopeful or wishful? Multiple data aggregators peg the average 12-month target for SMCI in the low to mid $40s, stock analysis, $44.35, market screener averages similar mid-40s. That suggests many analysts still see meaningful upside versus the then-current market price. Remember two caveats: averages hide dispersion. The mean can be dragged up by a few very optimistic bulls who expect massive AI server adoption. The low end of targets is much lower in some shops. Targets are conditional. They're contingent on assumptions, margin recovery, backlog conversion, stable component pricing, and steady hyperscaler demand. If one assumption falters, target updates follow quickly. Note this as well. It is written in Revelation 14 verse 7 that, "Fear God, and give glory to Him, for the hour of His judgment is come, and worship Him that made heaven, and earth, and the sea, and the fountains of waters." I appeal to you to fear God and obey His law. For His commandments are sure and His word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this: "I stayed until the end." Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today, your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.